Yeah. Which one?
Give and see.
Myanmar.
Okay, Jackie, I was saying that for the donation, we have 3 forms of donations that URA accepts as expenses. It allows you to deduct them from your gross income. And they include, if you make a donation to an amateur sports club, we shall allow you to deduct as URA. In case you make a donation to a religious institution, we shall still allow you to deduct it. If you make a donation to a public institution that its intention is to benefit the public, we also allow you. Donations regarding any other thing, if you donate to a friend, if you donate to another business, like in this case, we are now donating to maybe a political party, you're donating to the youth, we are saying, because benefiting the youth are not the public, okay? Someone would wonder, but the youth is supposed to be part of the public. Yes, but it is segregative in nature. Okay, if you're, for example, donating to construct a road, then we would allow because everybody's going to use that road. Okay, so that is what URA considers. Any other donations, we shall not allow you to deduct them from our profit. Okay, so Jackie, I hope we are fine as far as that is concerned. So let me go back to the factory. Okay, so for the factory, we are saying that it's taking forever to come. Okay, so I was saying that for the factory, you look at there are 2 things that stand out on the factory. Okay, one is if the factory has been around, and the other is if you have an extension to the factory. Okay, so I'll explain them this way. That for the factory, assuming there's no extension, you have been having this factory since. Okay, this is what would happen. You would have a formula like this: A times B times C over D. Okay, and we're saying A, just to save your time, it's supposed to be 5%. Okay, then B is the cost. The cost of the factory, what we call the capitalized cost of the factory. Then C refers to the number of days used for operation. Used for operations during the year of income. Then D is the normal year of income. So I'll just put 65 days. Okay. So that's the formula for you. Just substitute and you're good to go. So, but this is on a condition that you have had this factory at least last year. Okay, so you just apply the formula. Okay, then the scenario where you just acquired the factory. If you have just acquired it, just acquired the factory. Okay, maybe you have just bought it or you have just constructed it. We have what you call an initial allowance. Okay, we don't depreciate, yeah, in that year or in the year you acquire the asset. We just give you an allowance, initial allowance. Now this initial allowance is split into 2. You have it when if you're within Uganda, if you're within Kampala. If you're within Kampala, we shall give you 20% as the allowance, 20% of the cost that you have incurred in acquiring that asset. Then if you're outside Kampala, okay, they say more than 50 kilometers. But personally, I think since for our case, it's either within Kampala or 50 kilometers away. So they can't confuse us in any way on that. So my idea is outside Kampala, therefore. Outside Kampala. Likely will tell you Karamoja, is it Kabale, some distance. So that one is 50%. It's what they allow for tax purposes. Okay, so this happens when you have had the asset since last year. This happens when you have just acquired the asset. Okay, then there's when you have an extension. For an extension, if it has happened within the year, nothing changes. It's the same. You treat it as if it is a normal or it's a new factory. You have just acquired a new factory. So you will treat it this way. You have initial allowance within Kampala 20, outside Kampala 50. Okay, I hope we are on this. I'm just going to give a scenario with a few figures, but this is the case. Try to understand the actual thing, and then when you see the question, to always come out. You can respond to your chats. Hello, yes, we were told write down value carried down is less than 1M. Also allow that amount as an allowable reduction since we take it under the allowable reduction. Okay, if that is the case, maybe, but my argument is that a write down is not an expense. It's just like if you say the carrying amount of an asset is 20M. How is that supposed to be an expense? How is that supposed to be allowable? Yeah. I'll maybe confirm. I'll get back to you on that, hopefully, if I don't forget. But what I know is if the write down is less than, because that's the carrying amount at the moment, less than 1M, we shall still charge the depreciation and get the final wear and tear. Okay. Nita is saying, pardon, where is okay. So Davis, I hope I've answered you on that, but I'll try to clarify on that next time. Where do you apply the percentages for? You apply them on the cost of the asset. If you spent say 10M on acquiring the factory building, or yes, on acquiring either building it or buying it, you're saying that the 20% is on the 10M that you have spent. Okay, something with the extension. If you have spent 90M, for example, on putting an extension on a particular factory, you're saying the 90M that you have spent on the factory will be charged at 20% or 50% accordingly. So Esther, I hope I've answered you on that. Pardon, where is the extension of a factory building? It's not part of the question. We're just giving a scenario. Nita. Pardon, the extension. Yes, I'm saying if you meet the question saying that you had a factory of say 50K, 50M, then they're saying during the year of income, you had an extension or you made an extension to the factory. Okay. By extension, we mean that the factory, say you break one side of the factory and expand. Okay. Try to increase its capacity. We are capitalizing, or we are okay, I don't want to take it by 16. But in short, you're capitalizing that a building of 20 kilometers squared, an area of 20 kilometers squared. If you break one side and expand so that it now occupies 30 kilometers squared as an area, that is an extension. So that extension, we're saying you treat it as if it is a new factory, as if it's a new factory. So you don't add the cost of the extension to the existing cost of the factory. No, you treat it as if it is a building of its own. Okay, what if the factory building had land value and what? Yes, Jackie, if they say that the value of the factory and the building is 20M, and then they tell you that the value of land is 10M. What's the value of the fact of the building? Automatically, it has to be the balance, which is the 20 minus the 10, giving you the 10M. So that shouldn't confuse you, Jackie. If they give you a single value, they say that the building, the factory building and land is valued at 8M, and then they're saying that the value of land is 20M, automatically the balance becomes the value of the factory building. Okay, if they tell you that the factory building is 20M, they've told you the figure. Don't look elsewhere. Just know that's the value of the factory building. Use that one. Okay, I hope I've answered you, Jackie. Mariam, what if they, okay, guys, I'm going to first do what I'm supposed to do, then I respond to your chats. Mariam, you're the last person I'm going to respond to. Okay. What if they give you the cost of building and also at the same time the amount of extension? Of course, they have to give you, Mariam, they have to give you those. That's why I'm saying that they'll give you the value of the building, 20K. They tell you the extension was 5K. Yeah, they have to give you those values. They can't, there's no way they won't give you. So if they give you, like I've already said, or if they don't give you, you still have to find them so that you have to deal with the factory alone, the building that was there, you deal with it alone, and then you deal with the extension alone. Okay, and I've said that the extension, you treat it as if it's a new building, and I've shown you how we do that. Okay, so back to this. So this is our, I hope you're seeing the image, because as though it is small here, but I hope you guys are seeing the figures. So a scenario is, if you have a factory, maybe you bought a factory building. Building maybe 200,000. Okay, 2 years ago, and this year made an extension. The building that costed us maybe 107,000. Okay, assuming these figures are in millions, just so we're saying calculate or compute calculate the wear and tear or depreciation, whatever they say. Okay, so what I'm saying is, what you had as a building, the old building, you treat it the normal way. Saying the issue is that it is 10%, 5%, sorry, times the cost of the old, okay, times the number of days you have been using it for operations. So in this case, I didn't specify, so you assume the full year, okay, over full year. Equals. Okay, so this is what you have. Then we're saying the answer will definitely be that this is what you incur in terms of wear and tear as far as the factory building is concerned. Then for the extension, you deal with it differently or separately. The same extension is 10,000, but okay, show me in the factory. Okay, I didn't say many things. Show me the company in Kampala. Okay, so they're saying you come and say initial allowance. Okay, it will be 20% because it's in Kampala times the 10,000. So this will be your initial allowance, and therefore, in your schedule that you do, you'll go under allowable deductions and remove this 10,000, okay, allowables. Then you come also on initial allowance and remove the 2,000 under allowables. Okay, that will be how you determine the chargeable income later. So guys, unless you have any questions, we're now going to look at partnership. Okay, so that was a business. So if you go to do now partnerships, with the same question, unfortunately, or fortunately. Okay. So begin with the format as usual. If things change on a partner on a partnership. So this is what happens for a partnership. Partnership, what we do is the first thing you do is you behave as if you're dealing with business income. You begin the same way, like profit before tax. Okay. If they give you profit after tax, then you know what to do. Adjust until you get profit before tax. Someone saying, where do we take those figures of 10? I've just said someone should answer her. Yeah. Thanks, Shakira. Net profit before tax. Then we add none. Same thing, same logic, same everything. Okay. Then allowable. Okay. This is a partnership, remember. Now, what's new in partnership is that they are what we call partner activities. Remember in our intermediate, partner activities. Partner activities with the business. Partner activities with the business. These are also first removed as far as the tax computation is concerned. That if you have any partner activities that were recorded in the profit or loss, you must remove them. So meaning that if there were incomes, you're going to less. If there were expenses, you're going to add. Isn't it? Yes. So partner activities include things like salaries, interest, drawings. Okay, drawings don't come here, but interest on drawings. Okay, then interest on capital. There are a few. Interest on capital. Okay. So these partner activities, they're supposed to first be removed so that you have officially business income. Then when you have business income, then you come and now deal with partner activities. Okay, I don't know why they normally do that, but that's the format. That you first remove the partner activities, have profit before partner activities, and then you deduct now partner activities according to the deed and the act. And then the balance is not shared by the partners. So these activities here that you see now, for example, salaries and interest on capital, we know that these are expenses, the deductions. So if they are included in the profit or loss, we are saying you add them under non-allowable. Add them so that in adding them, you're actually removing them. Then for interest on drawings, we know that interest on drawings is an income to the business. Okay, if a partner withdraws, say 10M, and is going to pay an interest of 10% on the 10M, as a business, you're going to get that income, that interest income of 10%. So because this income, we remove it by lessing. Okay. So that's the whole thing. And you're done with the partnership. Okay, not done, but after doing that, now you have profit before partner activities. Okay. Okay. Then we now officially now bring the partner activities. Okay. What you did up is what you bring again this side. So that's what I was saying. It's more of a repetition, but nothing to do. So what you do is you add back interest on drawings so that you have a profit with that interest. Then you less salaries, also interest on capital. so that you have a profit available for sharing, That's right English, but it's available to be shared by partners. And then you share. Okay, so in sharing, of course, we share based on the ratio. Okay, assuming your partner A, partner B, okay, they share the profit based on the ratio. Then after that, you now get what you call the chargeable income.
Excuse me.
Yeah.
What if the partners don't have the sharing ratio? What do you do?
Okay. So if partners don't have sharing ratio and the statement is silent, it has not told you that you're using capital contribution as ratios. Okay, it's silent. What we do is we share that profit equally. Okay, if the partnership deed is silent, we share that profit equally. Everyone takes a half. Okay, but if they're specific and they say they share in the ratio of their capital contribution, then you use their capital contribution ratios to get the ratio. Okay, if the ratio is clear, then use the ratio. I hope I've answered you on that.
Thank you.
So then you have a chargeable income for each. Now, under each, ideally, what you have is each partner's sources of income. Okay, we look at the profit that they got. You look at the salary that each got. If they have any other incomes outside the partnership, say somebody has dividends, okay, maybe someone has interest, someone has maybe a motor vehicle, whatever benefit he has outside the partnership, supposed to be included, including any benefits that he gets from the partnership, like salaries. If he's driving a car of a partnership, those are benefits. We do what? We add them together if you're charging him. So I'm saying, for example, for A, shall get his share of profit, then add any salary if he earns any. Okay, add any benefits in kind. Benefits kind. Okay, add any other sources of income, what you call individual incomes, any other individual incomes, as long as they allow you for tax purposes, that they allow you to gross. Then you get the chargeable income officially. Okay, and then you attach the pay rates. Okay, the pay rates for individuals. Partnerships, we don't tax the partnership itself, we tax the partners. Okay, and partners are individuals, so we use the pay rates that you know, the one of 2.820 per annum. Okay, and others. So this is the format. Okay, unless you have any questions on it, I'm going to use it to do the number. Okay. So since you don't have any questions, you can use it and see how it goes. So you come, like I said, the normal way you did with business. What's differing is now you have a few items like interest on capital, interest on drawings, what you call partner activities. Okay, so back to here. I will use, I want to avoid scrolling back and forth. So you're saying you have a net solution. You have a net profit. I'm saying it's profit before tax. Profit before tax. Okay, so this one didn't have any provisionals, so Yakawa put 500.
Excuse me, Kataraz. Yeah, I'm inquiring that do they say that maybe a portion, or if they just give you a question, you just have to do like that?
I've not understood when you say a portion, but if they give you any question on partnership, usually it's like this. If it's standard like this, very long, you have to do like this. Okay, I didn't read the required. What if we are given both drawings and interest and capital? I thought I've shown you how we treat those ourselves. I just talked about them. To answer Jackie's question first, you're saying this is a question they will ask you required. Compute the adjusted gain assumptions. Now, for this one, adjusting partnership profit, supposed to remove all the partners' activities. Yeah, the first step that we saw. Okay, by reading if you understood the format, even when you read any other information, it should make sense. If somebody is saying you compute the adjusted partnership profit for income tax purposes, what do you think he means? Okay, clearly he means that you look at the first profit we got. If I'm taking the format that we had. Oh, I deducted it, sorry. I removed it. But here they're saying that's the profit where you, after adding all allowables and, adding non-allowables and removing allowables. That is the profit you're referring to by part A. That's what they're saying. Then show the division of profits among the partners and their tax payable, stating any assumptions. Now this part here, they want you to allocate the partner activities that you did and then use the shares or share ratios to distribute. Okay, we're going to see how we're doing it, but ideally that is it. Okay, if it's in a partnership, they always ask for all these steps, as long as it is a 20-mark question. Okay, I can pardon you on that, no problem. We say, so back to Sophie's question. She's still asking, if they give you interest on drawings and interest on capital, how do you deal with them? And I've said those are still partner activities. You deal for interest on drawings, you're saying it's an income. So the way you deal with it is different from the way you deal with interest on capital. So interest on drawings, because it's an income, the first time you're going to less it under allowables. Then the second time when you're getting profit available for partners, you add it back. As we shall see, because I think we have it here. If you don't have it, I'll put it there so that we all get a feeling of it. Have interest on capital. Let me add that part. Interest so it's very to work. Interest on drawings. Actually, it's always this side of income. It's not even in expenses. Okay, it should be here. Interest drawings. Okay, assuming it's only one person who borrowed team. Okay, should I put in just 10,000? Okay, so the income here must increase by 10. Okay, so just to answer selfies and any other person who had any question on that, if you have interest on drawings, what would you do? Okay, so the first thing is, like I already told you, you first deal with additional information. This is non-allowables, then you less. Okay, what you already know. So what you already know, you're not going to do much really. Just going to just walk through it since they're the same things. So you still do the same thing. Come under sundry, look out for non-allowable, remove it. So here we agreed on the subscription is 1,400. Come and say subscriptions, subscribes. 1,400. Okay. Then the other one was what? Then you had repairs of 6K. I want to be repeating myself, so I hope you cover. Then you say repairs 6,000. Then the other item is We saw the other thing was what? Now we have partner salaries now. Okay, so partner salaries we're saying they're not allowable as far as so it's 28. I'll just take a solid figure, 28. So partner salary we know it's not allowed. Okay, for now, partners salary. You put 28,000. Right, then you continue. What else do you have? Then you have tax allowable, tax agreeable capital allowance 840. So it's allowed. So you come and put it here. Yeah. Capital allowance. Okay. So I hope you're covered because I'm being fast, but because you have been around, so you know what you're doing. Right? Allowance. $840. Okay. Then we also have wear and tear. Okay. This part here, wear and tear, we saw the workings. So I won't go into it. Just borrow the figures. Okay. 12 and 6, that will be 18. So you bring the 18,000. Wear and tear. You're saying it's 18,000. Okay, I think this figure is too big. I should have put a smaller figure. Then we have, then you come back now. You come up and move line by line. Okay, so you're done with additional information. Come and move line by line. Any item you haven't touched, you try to make sense of it. So gross profit, you're saying that is allowable. Interest on drawings, saying okay, this is partner's stuff. Sounds a good idea. We remove it, 10,000. Come and remove 10,000. Okay, but remember this is an income. So if it's an income, the way we remove it is by coming here. Say interest. Okay, 10,000. Okay, then you continue moving on the line by line. Then you go to expenses. You have rent, sundry, salary, bank interest, repairs, legal, stationery, traveling. Then you have partner salary of 1828. We removed it already. Then you have depreciation. So this is accounting. Depreciation is not allowed for tax purposes. You remove to 700. Removing it, you're saying because it's an expense, put it under non-allowable depreciation. $700. Okay. Then we move on. What else? Then you have interest on capital. Okay. Just on capital is an expense. Total is 1,000, and it's not allowed for tax purposes. So it's not allowed. We remove it by putting it under allowable. So it's interest. It's 1,000. Okay. So then you have donation. We already talked about this one also, saying it's not allowed for tax purposes. So come and remove it. Donation is 4,600. So officially you're done with all the additional information. Okay. Self-mint interest on drawings and drawings. Okay. Now for starters, for drawings, they are not allowed under an income statement. Okay, from your accounting 1 or from your accounting 3 now. Drawings is not an income statement item. Okay, it's not supposed to be under income. So that one is supposed to remove it immediately without even thinking twice. Okay, if it's put here as part of the expenses, you remove it because it's not an expense. Drawings It's not an expense. Okay, so I hope I've answered you on that one. Okay. So so officially we get the figure. I want to get the figure because I didn't use Excel this time. So first of time, I'll just give you an assumed figure, right? So saying what you have here as a profit before partner activities. Assuming we get maybe 200,000. Then we now go to the next step, which is you remove all the partner's activities. And when removing them, the first thing is you add back the income, which is the interest on drawings. Officially, you're recognizing the partner's activities after. Okay, so as you're going to see, it's just the reverse of what we did the other side. So you add the drawings on here, should be 10,000. Okay, then you less expenses. Okay, we have interest on capital. Is check the amount is 1,000. Okay, say 1,000. Then you also have salaries. Salaries for partners. Uh, 28,000. So bring. So take the total, which is 29. Therefore, I have profit available for sharing. Partners. Okay. This will be 19. It will be 1. 81. Okay. Yeah. Then you share now this. Okay. We allocate or share. Allocate or share within the partners. Now you have a team and you had here. So of course they share based on their sharing ratios. So in this question they were given, you can just confirm. Here they say that Otim and Lukia have been in retail trade of Chikubo for these years, and they share profits and losses in the proportion of 2 to 3. Okay, that's the ratio. So meaning that our team has 2, then Lukia has 3. Then you apply. Okay, now the link is closing and I don't intend to issue another one. So after sharing, if you bring back these guys' activities, benefits specifically, salaries and their share, then you charge pay rates. Guys, thank you for attending. The link is closing shortly and I intend us to stop here. It's 10. So if you have any questions, feel free to. Yeah, it's going to close the link. So
Excuse me.
yes. You ask, but the link won't allow you to. Maybe we shall just, okay, for those who have questions, you come back again on the same link. We answer those few questions and then we go.